Hot in the mood. Type time we on. All the way live. All the way live. All the way live. All the way live. All the way live.
Hey guys.
Muni man.
Hey, I'm on the treadmill, so I just got home. I got a dual mandate here. I gotta keep my body moving or I'm gonna get real fat.
We're all on the treadmill. Jerome's treadmill.
I like
Jerome's
it.
treadmill from hell. Let the seats fill up before we take the stage here. Actually, I just got to get this beer. You know, it's one thing to make a bad call, and you know, I certainly, I'm, you know, as the name of the space indicates, I'm certainly made a lot of bad calls here over the last 2.5 years. Or followed other people, blah blah blah. When we're all in this together, right? We're all accountable for our own decisions, and so you know that is what it is. But the other, what I'm trying to say though, John, it's so interesting to me is like, yeah, it's a bad call, but it's like it's a business model, really, right? Like to me, what's so interesting is like the 60/40 business model, you know, is coming apart at the seams. I don't know. That's my take from, you know, I guess the trenches here of retail wealth management. I don't know if you guys have thoughts on that. Maybe it's just a jumping off point.
Well, I think.
Well, let me
go ahead.
Let me start, John. Just the two kind of macro things. One is you had asked about market commentary, Turtle, and I just got my October 2nd update from J.P. Morgan. I've got 200 million that I might price tomorrow. We've done day to day. And so the market commentary says, talks about U.S. Treasuries. I won't go through it, but that we had a continued steepening in the yield curve. And then it moves to munis. It says that high-grade tax-exempt yields increased across the curve, 27 to 29 basis points, during which long-end rates reached their highest levels since 2013. Munis underperformed U.S. Treasuries across the curve due to open-end fund outflows, modest ETF inflows, and selling pressures. Elevated after-tax yields contributed to a significant rise in long-end trading, with purchases up 49% in 20 years and longer. ETF flows now make up 45% of total capital moving in and out of funds this year, amid increasing offerings resulting in ETFs accounting for 13% of total assets under management in all muni funds. Lastly, in the short-term market, SIFMA reset down 3.98% from 4.31% the week prior, as tax-exempt money market funds assets under management increased over $1 billion, and bond funds, SMA investors began to deploy their October cash into VRDBs, variable rate demand bonds from notes. So that's the commentary you'd asked me to get something on that. The second thing I want to say is you know, everything that I own in a fixed income other than a money market, which would be municipal bonds, which would be target term fund, it's depressing to look at an NAV down 9%, But at the same time, it's no different than holding a CD of 2 years, having the market go against you, and in 2 years you get paid off and you move on. So first, I think the pain right now is in the trade, not the hold to maturity. Sure, I think that there are people that would love to kind of play it both and straddle it. But if you're a hold to maturity investor, the only thing that you're kind of doing right now is looking at your portfolio of duration and saying, when do the next bonds come due so I can then re-roll them into the long dated bond at a rising interest rate. If you're trading and you're playing with money that you might actually need before the hold to maturity plays itself out, that's a totally different perspective. That's something that you might want to hedge against interest rate risk, things like that, if that's how you choose to deploy your process. But I'm a hold to maturity investor. Now, from a professional perspective, I represent municipalities. I'm giving advice tonight on a transaction on whether we go tomorrow. And when I issue a bond for a client and I see a 4% coupon in 20 years in a 10-year par call, that means 10 years, fast forward 10 years, whatever you bought that bond at, you earn that rate of interest. When I get to the call date in 10 years from now, think about how many things can happen in 10 years. I know that the probability that I, as a municipal advisor, will refinance that bond out at a lower rate for my client is extremely high. So that's just a different viewpoint because I don't manage people's money day to day. I, manage debt portfolios for municipalities. And so if I own let's just take one of my worst performing bonds in my portfolio that I personally own, Woodford Kentucky Schools, which is next to Lexington. They breed all the Kentucky Derby winners there. It's a great county. We do not do their work. My firm does not do their work. Could own their bonds if I did. I bought fours to yield a 426 or a 430, somewhere in there. They're also insured by Build America Mutual. And the NAV says I'm down 9.6%, 9.3%. 2 months ago, I was maybe up a little bit. And last year, just about, and somewhere in October, I was buying fresh bonds, kind of just stress selling at 470 to 490. And I bought a 5% yesterday. I hit the bid on some Bowling Green Independent School District insured bonds at a 5 that someone was trying to dump. So again, I think there's two ways to look at this, and that's hold to maturity and trade. And I think the pain trade right now, or the pain trade, I'm using it the wrong way. I think the pain people are experiencing right now it's the trade of rates.
And it's finally gotten to the point where it's front page news, right? Whether you're interested in financial markets or not, you're probably aware at this point that interest rates have gone up a lot, and probably more so in the last couple weeks. I think that's a great point that you bring up. And so maybe that's an opportunity to kind of let me set this up a little bit. So, Turtle Capital, you guys follow me or don't, but I'm a retail financial advisor. That's what I in real life. And that's a certain vantage point. Camprath is John Camprath. I probably not saying the name perfectly
You're
well,
doing
but
great.
John.
Love it.
Okay, thank you. Is kind of like me, but just like a black belt versus like a blue belt. I mean, guy's been doing it a long time and knows closed-end funds as well as anybody I've ever met, or anybody I know on the internet. And so that's so point being, you have 200 customers with a certain amount of money under management is very different than having a couple customers with a lot more money under management. And then Muni Guy, everyone has their own vantage point. That's where I'm going with this. Muni Guy, of course, is so it sounds like you're, Brian, we'll come back to it maybe, but like is providing guidance, go, no go on a $200 million bond issue. That's fascinating. That's a totally different perspective. So let's come back to that. John, please introduce yourself. Tell us a little bit about your talk. I'm so interested because you've been around, you and Brian have both been in the market a long time. Has this move, how far it went, and especially recently, did it surprise you? Did it catch you off guard? How are you doing? Wellness check with
Hey,
John
thank
first.
you, Turtle. Doing great. Thanks for putting this together. It's kind of going where I'm expecting it to go. I had a long time where I was managing lots of client assets and closed-end funds up until a few years ago, and I wanted to get out of that just simply because of events that are happening like now. Because the deal with the retail investor is that so many of them are really relying on these investments we place for them, right, for income. Think of your retiree. They're trying to squeeze as much as they can out of their nest egg so that they can support a lifestyle that they're aspiring to, and folks seem to continue to aspire to more and more lifestyle. The more and more money they have, or unfortunately, even the less and less that they might have. And the closed end scheme is something that it works great until it doesn't. And what we've gone through is when it doesn't. And so I have restructured my business substantially. In fact, I recently just launched my own RIA and working more with a handful of clients. And when it comes to income, which they all need, I am extremely discerning on what I'm going to place them in. So I shared a big spreadsheet of funds that I track. I own almost none of those, but I know people who own them, and I know what they've gone through. I am terrified of leverage in investments right now for clients simply because when the cost of the leverage changes and skyrockets into, to Brian's point, SIFMA, it ticked down. Well, not to his point, but in what his prepared remarks were, SIFMA, which is that very short muni rate that resets on a weekly basis and is essentially the underlying rate that the leverage deployed in these closed-end funds use. That's it's high, and it's been high, and it's staying high. It's that higher for longer scenario. So you have levered investments where the leverage is almost working against you. It's not buying you more yield. It might even be eating up some of that yield. And so the ability for these funds to pay these dividends consistently has really been under pressure. And the spreadsheet will show you. Now, I break them out between non-levered funds and levered funds. And the majority of retail investors who own closed-end funds own these levered ones. And they're down, you can see, because I've recorded their cycle highs. We kind of take a cyclical approach. We don't worry about year to date or month to date. We worry about kind of cycle to date. When I saw that the cycle was peaking, I was like, we got to do something different. And look at what's happened with those funds. Many of the funds are now at their low. We had lows about a year ago. We've now taken out a lot of those lows. And so we're now down. People were feeling really rich maybe 12, 13 months ago in some of these funds, but now they're down 42, 43% over this period of time. But even more importantly, their cash flow has been cut. And that's kind of the red column more towards the right, where it says dividend X peak change in percentage. You can see how much the cash flow has been cut. The yellow highlights just simply show recent changes to dividends within the last month or two. And it's been this incremental thing where every few months these funds seem to be cutting their dividends, at least on the levered side. Although on the non-levered side, you notice that dividends actually have been rising over this period of time as interest rates have gone. In fact, if you just take MUB, the ETF, you can see that even though the yield's nothing really exciting in MUB and the price is down, nevertheless, the actual dividend paid, that has been rising. So if you're not in a levered vehicle, you might be participating in some pay raises. But if you're in a levered vehicle, and that's where so many retail investors really are trapped, they're trapped in something where they're down 40%, but their cash flow is down 30, 35, 40% as well. And that's devastating to a retiree's portfolio. So the point is, I saw this coming. We're out of all of that. And if we own anything, there's a little bit of this unlevered stuff. There's one position that's down about 10%. It's a BlackRock Uniterm Trust, and it's the 2037 target trust. And Brian and I have talked about that. It's gone down a little bit in credit quality, but it is continuing to pay its dividend. It's yielding now over 5%. I have incrementally added to that position even in the midst of this sort of collapse because there is no leverage. I don't see that that the fund is going to have to cut its dividend at some point in time when short-term rates turn around. This thing may be able to put some leverage on, and then we might be looking at some nice pay raises. But what I do is I take an approach where it's, look, clients need income. What's the most defensive way I can provide them that income without having to trade in and out of positions, and yet hold them in something that I can sleep at night and know that this is a lot better than just trying to chase yield, which is what so many people are doing, and their advisors are probably leading them down that primrose path until we're going through an event like we're going, which is essentially credit unwind, and it's happening in slow motion, but now starting to escalate. So anyway, I think we're seeing what I was expecting, and I would not be at all surprised that once this thing really accelerates, we're going to have further drawdowns in these funds. And at some point, it's going to be a buying opportunity. On the levered ones we're looking at over 40% leverage in most of these. I've been tracking this over the last couple of months. We've gone from like mid to high 30% leverage on the levered funds. They're now well over 40% leverage, some of them pushing 50%, which is about the max they can get to. I don't think it's time to buy that. I think that if you do, you're looking at a great opportunity to lose more capital. I would wait for those things to turn around. I don't know if that's helpful, but that's kind of how.
No, that is helpful, John. Thank you so much. And we have a looks like you just stepped down. We had a FinTwit mini celeb just on the stage, but this, I don't know who wants to talk about this painful duration shit anyway. But back to because you were bringing the juice there, you were bringing the wood, John, as the kids say. What? Let me ask you this. So that 2037 fund, what's that? BMN, I believe.
Yeah. Yep.
And so let me ask you, what do you have two things you said. One time we spoke, I don't think you mind me saying this, but one time we spoke and you told me, talking about the business, and you said something like, the rule was at my old shop, at some old shop you worked at, look, if you shower people in tax-free income, you're not going to get fired, or something. It was something like that. And after you told me that, it's I've just kind of other things I'm like, oh, that's people love tax-free income. They love talking about a tax equivalent yield is way easier than talking about why my shit underperformed so badly. So where I'm going with this is the return of premium thing is really interesting. Have you looked at or the Muni closed-end fund side is interesting. The Muni ETF redeeming ETF shares, so like the bullet shares from Invesco. Have you looked at those at all, John? Just out of curiosity.
I have not looked at the bullet shares. Maybe I should, but I have not. So I don't have anything to say on that, unfortunately.
No problem. So here, I'll give you a ticker. Like BSMR is 2027. So like a much tighter, get your money back much sooner. But there is some funniness around, like, if you actually, I haven't looked at the municipal side as much, but when I was looking at the corporate side, there's some bonds that come due way later. So I've never actually like watched one of these redeem close up, at least. But this BSMR, which is the 2027 municipal bullet share from Invesco, redeems in 2027. It's down 9.5% from the drawdown, or the total drawdown is 9.5%, which is coming up on its COVID, March 2020 drawdown of about 13%. And this guy will pay you today, 2.6 is what Coifin's showing for a yield, but those aren't always like super accurate. So anyway, blah blah blah. But I think it's an interesting concept. I don't but I was trolling for if you'd looked at these like closer. So
Right. Yeah. I mean, to me, something like that, I mean, maybe it's a little more secure if you do good research and you're confident that it's going to be able to pay itself out, and it's holding good paper, right? 2.6 is just, it's not a really remarkable yield. I mean, okay, we can reverse engineer the tax out of that and figure out what a tax equivalent yield is. Um, but I mean, there is an alternative, right? I mean, we can get 5.5% for crying out loud, just about in our money markets. I know it's fully taxable, or at least taxable on the federal level. Well, actually, the money market would be fully. Or we can we can roll T-bills and get something close to around 5.5%, and know that that money's going to be put back into your account when it matures in 3 months or whenever it is. To me, that just seems to be a little bit easier than have to worry about how are they managing the risk around holding the right paper so that when it matures in 2027, we're good. Because that is, to me, is an issue with BMN. They're targeting that they'll pay you back $25 a share at the end of the term, and there's a good chance BlackRock will succeed in doing that. But there's also a chance that they won't, right? I mean, there's portfolio turnover. It's almost 30% turned over this past year in that fund, and so that just begs the question: well, how well are they going to manage where this market goes over time so that they can redeem this thing and you can get all your money back, assuming you're in, say, at $25 a share. And if you're not, or if you are, you're down right now 10%, but that's on a stock price. And maybe the thing, just to remind people, if you're not familiar with how closed-end funds work, they're a mutual fund that these fund companies like BlackRock or whomever, Nuveen's a big player. There are many companies. And so they'll do an IPO, I should say, and all the money goes into the fund at the beginning, and essentially that's it. And so the shares are created at the IPO, and then they trade on the secondary market on the New York Stock Exchange typically. And so that's how you find liquidity. And so, of course, the joy is there could be some discounts. Well, the discounts have just blown out in these things. And so you can buy some of this stuff, and that's why it's very tempting, especially if you look at the levered stuff. I mean, some of the discounts are pushing 20% in there, certainly 13, 14, 15, 16%. And by historical standards, that's much larger than they've been. The discounts are not quite as large on the non-levered, but nevertheless, they are there, and it's very attractive. I mean, you're buying it essentially at a discount. So maybe you're down 10%, but you're buying an 8% discount on BMN right now. And I'm talking my own book. I could care less if you guys buy it and drive the price up. I'm not really interested one way or the other. I'm kind of holding this as it's down. I'm more excited that maybe you don't buy it because it stays cheap and I can add to it for clients because I'm here to hold it kind of for the long term. Anyway, so to me,
Hey,
yeah,
John,
go for it.
I got a couple comments on BMN. And I messaged you about it. So I'm sort of I have two viewpoints on BMN right now. The first is there is the long-term view that they add leverage later on because it's an option, but it hasn't been utilized, which is great. And the second is I'm interested to see the next quarterly update on the holdings because they don't really need to increase the yield on their underlying bonds. I think there's actually potentially an opportunity for them to move up in credit quality. So you sell, these, I'll just call them transportation bonds that were yielding 470 that are probably, they'd have to dump them at, 5.25, let's say. They do that, they create a tax loss, which is beneficial. And then they go and they buy GEOs and schools and water and sewers and bonds that are higher in quality, but are yielding the same amount that they're currently paying out. So there's no change in the distribution rate. They simply have tax loss harvested and then moved you up in credit quality. And they've gotten everybody essentially kind of pregnant on this distribution rate in terms of a dollar amount, not a percentage. That's my first thought on BMN. My second thought on BMN is there an opportunity if, they don't do that or you don't have the trust in the strength of the management? Do you then sell some BMN and create your own tax loss, and then move up in quality in a fund like MMIN, which is the only other fund I've ever really truly liked or owned because it's insured paper. And I haven't done that, but I've been thinking about it. And I kind of would ask your thoughts as, someone managing money. Do you see that as a viable option?
Shit. Sorry, Muni guy.
Do you see that as
My bad.
viable option to consider, or do you not see that as a viable option?
I think it's definitely an option. Taking a tax loss can be very helpful to the client. If anything, it just simply buys you time, it buys you the ability to have some gains in the future. So that's always a prudent thing to consider. And given kind of where we're at, if we can migrate clients into something that has definitely higher credit quality and is essentially a safer asset from that perspective, it's certainly worth considering. And whether it's an all-in or a half-in or a 10% change, that would vary from client to client. A lot of it has to do, in my opinion, with what are the needs for the client. That's why everything has to begin with a financial plan. And really beating up on what's the risk, what risk is possible for the individual client. So it would vary from client to client, but I think it's brilliant. And I think the only thing I'd add to the BlackRock analysis is just simply, look, this is just one fund. BlackRock has many. They're a big player in the muni space. I just wonder how objective they would be about what they choose to purchase. Are there going to be competing interests that might influence what they decide to do with respect to growing up credit quality or not, and what decision chain are they kind of following there? Obviously, they're fiduciaries, but there's always pressure from on high to make sure that there's exit liquidity when it's needed. So, I'm certainly not all of our eggs are in one basket here. I would love to own a lot more muni than I do at this point in time, and hopefully in the future I'll be able to add and find other positions, as well. But I am way underweight municipal bonds right now for clients, just given where we're going, and I'm not sure how it's going to work out. And I'd rather be a little late than worry about being early and backing up the truck and buying the stuff.
I want to get to our Canadian panelists here, but before we do that, John, let me ask you this. Let's say I win the lottery and I can hit your minimums. I come to your office. We have a nice meeting.
Okay, thanks for that, John.
You bet.
What are we buying now? Like
Turtle?
what is it? Yeah, go ahead. Muni guy, what's up?
Hope we can't hear Turtle right now.
Tell him to step down and come back. Tell him it's Elon's fault. He fired like 85% of the staff. It's amazing.
And we may have temporarily lost him.
I can hear you. I can hear both of you. So I don't know if you can hear me.
You can hear Turtle?
Yeah, tell him he's got to step down and come back.
Step down and come back, man.
Okay, I'll drop down.
I'll bring it back.
Gotcha. Yeah, I can hear Turtle.
Yeah. So real quick, where was I going with that? What day is it? Invite to speak. So, what are we buying? That's my question. So a bunch of great points there. I don't think I don't think I've gotten you to mention what you are interested in at this time. Or if you did, I miss it. Is there anything? And again, not of course. This is Twitter. If you're taking investment advice,
I'm definitely like all the rest of us, supplying any investment advice at all here.
Right. I am, but look at my feet. You don't want it. Keep going.
I am not.
Yeah, no. Look, I'm enamored with being safe. So look, people who've made a lot of money, they don't want to get rich. They just don't want to get poor, right? So even though they might have a hankering for income, it's all about just being as conservative as you can through times like this, and wait around. What I'm interested in, and I'm exploring, and I'm finding some opportunities, would be in some credit opportunities where firms and funds, some of these are private funds, can come in and purchase credit at the right price, repurpose, maybe even take them through bankruptcy, but really buy as this thing is unraveling. So I'm looking at that because that could also supply some yield. but I think could supply some really great upside, in the future. We may be a little early, but sometimes things start going really fast. So, and it takes some time to get into these positions. So I'm looking at stuff like that. I don't want to mention names, just I don't think it'd be prudent, but if you do your research, you can find it or DM me, whatever. Happy to chat. So I'm looking at things like that. I'm being a little selective of there's a little bit of real estate that may be attractive, and I may look at some of that as well. Some of the yields are good because, again, if I'm confident that the cash flow is consistent and isn't going to be wiped out, so you got to be really careful in real estate right now. But I might look at some things there and just might ride down some drawdowns of some of those positions. But again, it's all comes down to position sizing. And how much you're willing to go in any one position on the one hand, and how much you'd be willing to allocate to the sector as a whole on the other. And that just requires a lot of discipline. And I'm not even looking at my book right now, so I'm kind of just talking from recent memory and what I'm doing. And otherwise, I would rather be very cautious or put some hedges on than just rush in and think it's time to back up the truck and just buy a bunch of stuff, because so many shoes are yet to fall off the feet. And we need to really get this bankruptcy cycle going. And until the wildfire really gets whipped up, I think you could be really early and regret that. And your clients won't appreciate it. Because as much as we want our clients to evaluate us on a cycle return, a cyclical return, peak to trough to peak and trough to peak to trough, nevertheless, they are looking at, their statements every month and every quarter. And you got to keep them in the game. So, a lot of it is just very prudent client selection, and that's not really what you're asking about, but I am being very cautious and enjoying lots of taxable but stable income from treasuries right now. Short-term T-bill.
Beautiful. No, very well said. And I think you're right. I mean, this isn't necessarily like a, stockbroker roundtable, but yeah, that's it. And I think to your point, I think really, I wish I would have talked to you 200 basis points ago on the 10-year, but also I think the client selection point is just so key for anybody that is in that racket. But anyway, more interesting, Thomas George with us on the panel.
Hey, Turtle,
Thomas,
what's up, man? Hey,
from
hey,
Grizzle now.
yeah,
Grizzle now, something else, DRUP, something. Disruption at a reasonable
DARP,
price.
man, DARP,
Dark. Yeah.
disruption at a reasonable price.
Let's
Yeah, well,
go.
listen, let's go. Listen, you know what? Like right now, interesting, like fascinating discussion about like safety and all that, right? Like one of the names we own, So here's the pro. Last year Nextera was our top holding, fucking in like growth. We're like, listen, this still has an above average market growth. It's gonna be our safety fucking valve. We had it at 11-12%. We just like fucking rammed it in hard. I had people chirping at me, oh, it's a growth fund owning Nextera large. I'm like, whatever, I don't care. I don't fucking protect shit. But then now this year we've ratcheted the name down, not enough. We took it in the first quarter, I think it was still like kind of weighty. Then we took it down to like 5, and then we like second quarter we took it down to like 2. And I still feel like I'm like, holy shit, this is bad. Like so, but long story short, like I've been covering utilities like most brutally, like the most brutal assassin anyone's ever done to me in my professional career is give Thomas George. Like, you really have to fucking hate me. You really have to fucking hate my personality to give Thomas George coverage of utilities in asset management. And that's what I had. I was
Let's go.
like fucking assholes. They gave me utility. Like, you really want to break a man? You fucking breaking a man? You're gonna break.
Where is this? You're talking about at a sell side shop you worked at?
Yeah, no, buy side shop. So I was like, listen, I want to do growth. I want to do fucking fun. I want to have a good time. They give me fucking utilities. I'm like, you sons of bitches. And then the whole renewable wave came. I'm like, that's karma for you, right? Fucking there, bitches. I'm like, listen, this is a growth sector now. You fucking motherfucks. And anyways, I kind of follow the whole thing. I was a god for owning Nextera through like, 2007 through through the 2010s or whatever, right? And then, but just the nature of utilities, right? Like there aren't a lot of people covering it. It's just most people just view it as a proxy for bond yields, yada yada yada. But then when you look at what's going on now, it's a massacre. They've killed our boy, right? Listen, in the Godfather speak, what have they done to this boy? You know what I mean? This next Terra was like the golden boy. It could grow. It could give you a little bit of yield. It was the thing. But almost in this market, it's like crosshairs, right? It's like it's anti like with their renewable side, with their yield coal side. There was an interesting a tweet today. I sent to Scott. I was like, listen, man, I'm like, I still got to fucking digest what's going on with NextEra, but I do believe that there is some fucking serious money to be made on the utility side, understanding what's going on, separating growers with yielders and all that sort of shit. But like, I just wonder from an asset allocation perspective, how you guys are thinking about it, right? Like, it's like, that could theoretically be the fucking beautiful place, but right now it's hurting. And NextEra being the worst.
Dude, that is such a great comment, and or just all around. I just appreciate your energy and everything you bring to life, dude. In all honesty, not even blowing smoke here. But
Turtle, man, brother, you know what? I still remember us chatting, man. And listen, honestly, thank you so much for your support, man. It means a ton. Whenever I see you like and shit, man, I know, dude. Like, I just know, like. I like it's just an incredible place where we are right now, and it's great to see incredible voices on the asset management side, the planner side, the advisor side. It's just incredible. It's great stuff. It's like we're in a new frontier.
I work at the Death Star, but I am not part of the Imperial Army, dude. I'm a rebel. I'm one of us, and like we're gonna we'll take over this bitch.
That's exactly right, man. Well, that's what we need, man. You need the rebels inside, man.
Right. So a couple quick comments. First of all, the space is titled Duration Bond Holder, Bagholder Anonymous, not Fixed Income Bagholder Anonymous, because I wanted to make sure that our equity friends would feel comfortable here. And so Thomas, welcome. Oh my goodness, man. I mean, so a lot of what do they call them? Sacred cows or something is like the saying, but a lot of sacred whatever the fucks have been murdered in my book in the last 3 years. And one of them was this idea of conservative equity investing, like American funds, like capital income builder type, not, whatever, but like that type of exposure has just gotten wrecked. And it's like, what do you own? You own equity or you own debt, or you own stock or you own bond. And so that, I think that, and next standard, and what's so interesting about that is like these Utes, and especially, there's I think with all of this, it's way above my pay grade. I've kind of outed myself on like where I sit, and I think that clearly whatever's happening is like there's something. It's big. Yeah, I don't know.
Well,
I'll say this.
So, and maybe just to add on, so I don't know if you like the most illuminating interview, and I'm always blown away by the guy. Did you listen to the Warren Pies interview that we did like last week? I don't know if you heard the totality
absolutely.
of it.
I was like, holy shit, Warren Pies.
He's such a baller, such a bad motherfucker, man. He's actually like honest to goodness, like such a great guy and such a great you know what I mean? Like when you meet like honest people that are thinking about things, and you throw them things and they just kind of are thinking through it, right? As opposed to what's his name? Peter Schiff or something. They're always giving you a front right away because it's like, listen, I'm the marketer of this. I'm the marketer of Bitcoin. This guy's like genuinely thinking through it. Like, and that's pretty powerful shit, man. Like, I actually was like, shit, man. Like, he really got me to think about like if treasuries aren't going to be diversifiers this time from an asset allocation perspective, then what is, right? Because like if treasuries are correlated with the S&P 500, well, like that's not valuable in your asset allocation wheel, right? Like that's not. So you got to think bigger, and like you got to think like, okay, what's going to work? Yes, it could hurt owning some gold and owning some oil or whatever. You could think it's cyclically like leverage, but on the other side, this is clearly we're in a new regime, so you got to think different. I just think right now is such an incredible point to be someone advising asset allocation like riches and fucking like absolute fucking like just brutality of losing money could happen right now, right? The outcomes are very wide versus the 60-40 fucking Buena Vista.
That's just it, man. And I think 60, and that's so a couple quick points I think are really interesting. One is that, oh shit, just dropped my beer. The one is that woo, it's a party. One is couple quick points I thought were really interesting you brought up. So regarding like 60-40, I mean the business model is tough to defend as it is. Like I charge you 1% to do things that you could do yourself, but I do planning and I blah blah blah. But where am I going with this? It's going to get a lot harder if these bonds don't start pulling their weight. Like if stocks continue to grind higher and Tesla continues to go higher, and the yang continues to draw down, like this is not good for people sticking their 60-40 or for the sustainability of this business model. The other thing,
so internal is that
yeah,
is that the ultimate? Sorry, I put my phone in my pocket and then it fucking shut down. I'm trying to get trying to get on a ferry right now off the island, man.
Spilling beers in my office.
I've got to. I asked for my beer to go from the bar, so.
Dude, where are you? You're living like you're in Canada, but it's summer up there.
Sick, man. It's like plus. Wait, yeah. I don't even know the conversion to Fahrenheit, but call it 80 or 90 or something nice, something real nice. So anyways, I'm just like, I was like, I was sitting at the bar eating some food, and I'm like, listen, I got to catch this ferry back home, man. I got to see my kids. I got to come back, reconnect. But so the point, so the one question I was going to ask is that is this not the differentiator from an advisor's perspective? Be like, listen, whatever the junk they're telling you, with respect to the company line, the blah blah blah. This is the new reality. I'm not going to be radically different, but slightly different, right? I'm going to add a little bit of gold. I'm going to add a little bit more oil. Like that to me could be so nuanced, but yet so powerful and be such a great asset gatherer as opposed to, you know what I mean? Like I'm not going to have a view on 60-40. You know what I mean? Like, this is what the market does. Marchy March, right?
Yeah, no, exactly. And I think like it kind of comes back to like, people are just impatient and what is your value add? And man, it is, it's been a tricky couple years with rates kind of doing what they did. And yeah, man, I think, but what at the end of the day, it's a relationship business, and I think I had a good point there, but I kind of lost
it.
But
Turtle, it's like an incredible relationship business, and a huge part of it is just helping the overall aspect of the business. But the other side of it is just like, we've been in a period where the added value on asset allocation was so de minimis that I think advisors now could add a ton of value through asset allocation, if you know what I'm trying to say.
No, for sure. And I think, okay, so that's two quick thoughts. That's what I think, two things at once. I think nothing. So one thought is like, yeah, I mean, it's all about how you set your business up and stuff. But so to the people that in the audience, for those that are not advisors in that racket, I'll keep it very succinct here, I think. But basically the two very different business models. One is I talk to guys that are, a lot of AUM and stuff, and they talk about, look, I charge on stocks. Like I'm not going to charge somebody. It's kind of a financial planning move to be like, oh, I'm going to charge you on all the assets. Like I feel like more the Gen X baby boomer stockbroker guy, maybe. And I mean, you guys tell me your experience, but mine is that guy maybe is more likely sometimes to just put everybody in American funds or put everybody in a wrap account and index at the stocks. And that's the 60-40 thing that's so tricky, man. It's like, if your business is, oh, no, I manage the whole pie, but one option is 5.5% FDIC with no fee, and one option is I'm just going to put it in all this shit. And dude, most of it's been drawing down since March of 2021. Like, but it's going to come back. but I don't know when. And tell me about those kids again. So I think that's
Right.
that's the problem with the business model right now. The other thing is discretion, right? And like, look, I see like where Keith McGartman's in the audience. I was like, he's a real FinTwit mini celeb, and I hear him talk, and like, this guy's got not only discretion, this guy's got I don't know what deals, but my point is that like there's levels to this game, and if you're somewhere where you don't have discretion over client accounts, which I do on some and not on others, it fucking sucks, man.
Yeah.
I mean, that's I can't really describe it any other way. And so one more thing on that is that like when this client came into a relationship is very important, because so much of this, like you said, it's not hard to like shit on the guy across the street. Like that's not hard, especially now. Give me a statement, I'll shit all over this thing. But what is hard is, right now your performance is shitty too. So I guess what I'm trying to say is that you have to kind of think through, like, it's not hard to shit on other people right now, but you have to. I don't know. I feel like I didn't land that plane. It was going somewhere.
Totally,
Go ahead.
I get what you're trying to say. Like, but when everyone's negative, we're like, oh, who's the winner? Like, but the reality about it is that we could be in the first act. I know we got O'Hare in the audience, we got Keith, but we could be in the first act of a very different regime, right? And I think, to me, that's the most dynamic thing I've ever seen, right? Like, and the only thing you need to show, the only chart you need to show anybody, client, that we're in the first act of potentially a new regime is the 10-year over the last 30 years, right? Like, that channel is broken, and if this is the act of the new regime, what are my new close? If you know what I mean, And that, to me, is like, the banks can't articulate that because they're bozos. You know what I mean? Like the big asset managers, etc. That's where independents stand out, right? And I know O'Hare's out there and Keith, but just my 2 cents, right?
Yeah. No. So that, thank you. You're helping me land this plane. It wasn't that great of a landing anyway. But yeah, so no, that's it, man. It's like, look, because here's the thing with FinTwit. FinTwit's like, oh, you guys own bonds? You idiots! Like, why would you ever own a bond? And it's
like, come on,
because you're 24 years old if you're trading Bitcoin.
Yeah, listen. Like, we're talking about a broader asset allocation, but we've never really had to tweak 60-40 as much as we've had to now. And which is the very exciting part, right? Truly, that's the exciting part. There's never going to be a non-bond component, right?
Right. It's kind of exciting, except for every non-bond component that, except for cash, which I can't really bill on that easly, sucks ass. That's the problem. Right? Like, what about, and again, I've learned so much from FinTwit. I have so much respect for so many of the people that are you guys know what I'm trying to say. I'm hedging. And then here's the other part. Like, what about like HFND, like all FIG, like all these tickers with like our FinTwit celebrity, demigod portfolio manager, they're all down year to date. Like, show me the exception. DARP, that's the exception. But
that's what I'm talking about. But that Fred Flintstone and George
this
Jetson.
Podcast is sponsored by Crystal Reef. And we but no, I mean, so my point is like that is it, yeah, so blah blah blah, I don't know. All right, let's go somewhere with this. What else? Rates going, dude, but I hear what you're saying. I think it makes a lot of sense, and I think more and more, quite honestly, dude, look, if rates are going to stay here, which is a massive if, I will, why would I bill on everything? Like, dude, keep money in cash. Yeah. Just let me run some money, and I'll send you a bill.
Right, and so it's kind of like twofold, right? And so maybe the right thing is to be barbelling, right? To be like, listen, the best strategy, and I think Meb had a great piece on this with respect to EM. I have to dig it up, Meb Favors. I retweeted it. I thought it was really, really interesting about like how different allocations, like you can go super barbell, be like 50, like in places like where we are right now with respect to yields, like why not go barbell, be like 50% cash, but then other 50% exotics, right? You don't need the spectrum of things. Like it to me is like right now, intellectually, there's never been a better time to be an investor to beat your peers, right? And like, bottom line, right? So you obviously can, like, you can have a similar outcome to others, etc. But with a very different dynamic portfolio weighting, and it could be super cool, man. Super interesting time we're in right now.
Yeah, bro. But yeah, that's beautifully well said, and but except for that's what we tried to do in this cycle, right? And like, it's like, yeah, look at the back test. If you add TLT to your portfolio, you're gonna lower the volatility. You're gonna increase the what do they call it? Like crisis alpha, and now you're just fucked. Now you're just an idiot.
That's the thing with Turtle. That's exactly it, right? That's the thing with inflection points, right? If you are the advisor that's going to step out, out of your comfort zone and say this is the new regime, that to me could be very risky, but also incredibly lucrative. Incredibly lucrative. Obviously, you got to believe in the new regime, right? And that's the bazillion-dollar question, right? Can you believe in the new regime? So Turtle, were you at Future Proof? No, I wasn't at this one, but the one prior to that.
Now they pulled my the hotel comp never came through, so I didn't make it up there.
Man, well, listen, like, I like the conference, and I thought it was super cool. Like, in terms of like a forward-thinking conference, like, listen, like, they had Red Man, Method Man, like, what, listen, in terms of like being fresh and new. But what I found super interesting is, out of all the people that I met there, most were very, very still about, like, not about asset allocation. Like, that is just believe the mantra, and I can add a ton of value from your financial planning side, which, let's be frank, like, that's not golf. Like, that's actually really taking care. That's your financial fitness. That's real. But I just think there's just a latent opportunity there for a lot of really great advisors that are really good at financial fitness, but on the other side could do a ton more on the asset allocation side.
Dude, 100%. I was a kines major in college for one semester because I played sports, and I was like, dude, you eat good food, you like don't eat shit out of a bag, you work out, you rest. I don't know, it just seems so intuitive. I'm gonna spend 4 years learning this. I feel like financial fitness is no different. Like, it's like it's like whatever. But that's whatever. But so I think that it's a great point, and I really do believe that the John Camprath rep as I guess I've heard people call it rep as PM, where like your FA is like a portfolio. Maybe that's a weird word, but like more so like, hey, I have some money. I trust you, John. Will you watch the money for me? Yeah, of course. How could you ever run the money without understanding what me and what I want you, my risk tolerance and all this shit? But my point is also, look, I agree with you, Thomas, that like, dude, whatever is going on, like, shit is changing. The old guard is, I don't know, man. I mean, like, whatever is going on, like, whether this mean reverts or not, I do think that people are, well, look, especially with risk free at 5.5. A 1 year CD is 5.5. Why would you pay me 1% to speculate with your money if you can get 5.5 on an FDIC insurance CD?
Yeah, for sure.
Yeah,
like,
Turtle.
Thomas, you're supposed to say, listen, tell me a reason why you would pay me, dude. Damn. Go ahead, you guy. Sorry, we've excluded you from the conversation.
No, that's just great. A couple things that just my observations. I am not an RIA. I used to work for, as you know, Turtle. I used to work for a big firm and had Series 7, all that kind of stuff. And now I'm in the muni advisor world. But the playbook right now, what's supposed to have happened, right, is we have a market crash where everything goes down. And then the first thing to rally is U.S. Treasuries. Second thing to rally is municipal bonds. And then the third thing to rally is consumer staples and utilities. The problem with utilities, and I've kind of preached it all year, is that, you've got the small amount of growth and ingenuity and market share opportunities, but it's really a yield play. And you're playing in a new regime where it's just not an attractive yield at all. And so once I saw that, I kept thinking to myself that, we're in uncharted territories where, without saying any names, when you look at when you're in a certain growth and inflation environment, these are the things that are supposed to work on the back test. It doesn't appear to me that is where we are today. We may get there in, a portion of the way there. But if the Fed is not going to go back to zero rate policy, you have got a lot of different back tests that won't work. And, back to the duration piece, when John talked about the leverage side, one of the things that I have been kind of trying to figure out, and I'll probably call one of the desks maybe I usually call them Fridays, is if you ran a CEF at 33 to 40% leverage, and you now can't leverage, that's a portion of the bond market that's now gone, right? Like they have to unload those freaking bonds once they run out of tricks on return of capital and all. And so you have, less buyers net because leverage is gone. So the bond market in some ways to me has to reconstitute itself. And, what's the two ways you can go in terms of the fork in the road? One is we have the hard landing, we have the federal government cut spending, and we go through some pretty tough times, or we go Japanification. Heard a lot of people talk about it. I mean, it makes sense, but I 100% agree with what you're saying, which is there has been a conditioning of clientele and individual investors that just doesn't work anymore. And they're a little bit lost, I think. And I think there's some RIAs that are lost. And I think there's some RIAs that are stuck in certain shops that can't pivot and do what they want to do because they're working for, the bureaucracy. So.
Yeah. How big of a portion of the bond? I wonder how much of a difference, how big of a buyer are they in the muni market? Muni guide, like what percent? Like I just posted. Speaking of Warren Pies, dude, was that you guys or Thomas? I'm not sure if it was you guys or Kevin Muir that got into the carnival thing. Was that him? Was that you or
Oh,
that?
you know what? That
That
must
was
have been
Kevin.
Kevin. Yeah,
It was Kevin. Kevin.
yeah. So, and I haven't,
That was the best story.
Yeah, I haven't heard Kevin's interview yet. And we were shitting on Buffalo in our thing, and I'm like, listen, because I'm like, listen, I just kind of threw out the question. Well, what's going to happen with real estate here, and that is really the unknown, another unknown too, right? Like from an asset allocation perspective for a person's wealth, myself included, that's a big freaking, it's a big piece of my life. You know what I mean? And perhaps the risk is that real estate goes down, but the other side of it is it's an inflation hedge, and it retains value, and maybe millennials and all that, young millennials and less should just live with Buffalo. that was the gist of it, right? But this idea that you've been priced out, I'm sorry, it is what it is.
Yeah, I'm gonna have to move to Buffalo the way shit's going.
Hey, Turtle, I got to jump at 7, but good catching up, man.
Oh, yeah, you're talking in ESTs. All right, man. Great talking to you. Here, last closing question. You got to run probably, but closing question, unless you have any comments on Warren Pye's tweet I just posted to the Nest. What is going on with bonds? There are 5 big buyers for treasuries: Fed, foreigners, banks, pensions, and households, which includes hedge funds, blah, blah, blah. When the first 3 step away. So the question is, maybe you can provide some context. So I know you got to go. But the floor is yours. Turn this into I would love to hear your closing speech here. Tell me about how much do CEFs really set price in the muni markets, and whatever your closing lines here. Thanks for coming out, man. Good talking to you. Always great to talk to you.
Sure. I don't know what the percentage is. I mean, in all the years of me doing this, majority of my deals are competitive. On the negotiated front, the process of us bringing a bond to market, we 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 have an underwriting team. We market it. We have lists of accounts that typically buy certain types of paper, and we go and speak to those accounts. You've got bulge brackets, so then you move into insurance companies, and then you move into more of the retail space. And as we've moved out of zero rate policy, retail space and RIAs have become a much bigger buyer of bonds than before, because they used to have to rely on the CEFs to run leverage to make the yield, meaningful to one's life. Well, now the bond itself without the leverage is meaningful, and that's changed the game. So I don't know what the percentages are, but I can tell you that every day in the municipal bond world, we operate off of a yield curve called the MMD, Municipal Market Data, and we spread to that. And that gets set every day, and we monitor what the spreads are to the AAA rate. And that's really kind of as simple as it gets. So I can't say that I think that they control the market like Treasury bonds do, because the municipal bond market is a really tiny market when you compare it to the Treasury market. So those are my parting thoughts.
Ladies and gentlemen, Muni Guy, the man. Follow him.
Thanks, guys.
Subscribe to his research. Substack's coming soon. Haven't seen one yet, but it's coming.
Hey, I am going to, a few years from now, I will lower my role. And I've been talking to John. One of my goals is I actually want to do my own small crowd, but my own little target term ETF, where I actually buy the bonds that I want to own, not like these shit bonds that I hate, these credits that I hate. There's not the best fund for credit quality I have found is MMIN. Just because by default it's insured only. I've tried to look for funds that only invest in general obligation, only invest in water sewer, only invest in city, county, local government, school districts. Doesn't exist. And I think one needs to exist. So I'll leave you with that.
Beautiful. The man, the myth.
See you guys.
See ya. That's MMIN is a great point. I think if you don't track that, it's a good little ticker to track. So basically MMIN, look, I'm not a muni guy. I don't underwrite $200 million in muni bonds tonight. I'm just a dude sitting here in an office. But what is so interesting to me is that this is like, these are insured munis. So they're taking the, credit risk out of it. And basically it's hitting I guess you would call this, I'm not a technician, I guess you would call this a triple bottom, right? So this thing basically is touching 22.5 where it hit in March 2020, and then in the Q4 little shitstorm we had last year. So isn't that interesting, guys? I don't know. MNIN, great idea. I got it from Uni Guy, and I think it's worth watching. Well, shit. What Camprath? Camprath, not going to give tickers because he's a legitimate businessman. But can I ask you about tickers, John?
You can try, and I'll try to answer.
All right. Okay. Ticker symbol: Nancy, Charlie, Alpha, NCA, Nuveen California Municipal Fund. We have a 20% drawdown, a 8% discount to NAV. That is what's the Z score on that? I don't see the Z score, but I got an alert the other day. You can go to CEF Connect and set alerts for when the Z score of the NAV discount hits 2 or more, or whatever you want. So I know it hit the NAV discount hit a Z score of 2 recently. Pays 5.3, distribution rate, and no leverage. Buy or sell?
NCA 5%. I don't see it.
No, sorry. NCA is the ETF, is the closed-end fund. I see a 4.3 on the distribution rate.
I mean, that's an attractive California distribution rate. For sure.
No leverage.
There's no leverage in the thing.
6% discount to NAV.
Yeah. No return of principal. It's earning its dividend. That may be a very good thing to do. The thing is, it has done a great sell-off, and there is no leverage. So That could be. I would definitely look at that. It's at about an 8% discount, and that's really what's giving you that pickup in rate because it's trading at a discount there. I would look at that.
Can maybe, yeah, okay. So maybe just in helping us with in generalities, like when you're looking at these closed-end funds, what am I looking for as kind of like a get out? Like what can I look for to kind of detect sickness in the holdings? Like would that be like you were mentioning earlier, the distribution
Yeah,
cuts?
exactly. Well, yeah, I mean, see, these funds have to cut their dividends if they're not earning them. Once they've cut their dividends, historically, when we're in normal times, they usually right themselves. And if they're trading at a discount, they've already cut their dividends, and the price has dropped as a result of that. That's often a sign that this, may be safe to get into the waters, and you're able to pick up some pretty nice yield there, and have some confidence that that distribution amount is going to continue into the future. So we look at that kind of stuff. We also take a look at is it earning its dividend? Is it over earning its dividend? They used to report a thing called the UNI, the undistributed net investment income. When they rewrote the laws, they don't have to report that number anymore, and that is a somewhat helpful number to kind of see are they kind of overextending themselves in what they're paying out, on these things. I would also take a look at the leverage amount. Typically right now, leverage to me is just out. I'm not interested in playing that game. So this thing doesn't have any leverage. It's had a remarkable sell-off, and the stock price has sold off more than the NAV has. If you're in California and you can receive 4.28% tax-free, triple tax-free, it's definitely behooves you to consider that and put it up against its competitors. CEF Connect, you mentioned that as a resource. They aggregate all this data. It principally is coming through Morningstar, so sometimes it's a little stale, and sometimes it's not always 100% spot on. But nevertheless, you can get in there and you can compare. You can even sort by like California state munis and just see, what funds exist and what are they doing. But this is one that I'm just concerned that we're in the midst of continuing sell-offs, and if that continues to happen, I mean, this could be, priced at whatever. It could go down to 750, and I'm just picking numbers. I'm making numbers up, so it's not any kind of a price target. But this thing could definitely, sell off more, and you just got to be willing to ride that through. I would also take a look at the portfolio characteristics and just see what the credit quality is. Well, in this one, there's only 12% not rated, so the point is they're getting some yield kickers probably off of that stuff. It's 10, almost 11% triple B, but mostly it's double A, right? And then you take a look at, well, we've got a bunch of water and power stuff going on there. LA County, last thing, I looked, there's a lot of people down there probably paying their water and sewer bills. So, that's, this would be one I would certainly take a look at if I had California clients.
One more, EGF. This is it's a BlackRock treasure enhanced government. So we've got to have some yield in here, although I don't see it. Or yeah, I'm not looking, or I'm not seeing
Yeah,
it
it's
as
paying
leverage. I'm sure it's leverage.
5.13 on this thing. I wonder what its strategy is, as I don't follow it in particular. I mean, if it's helpful, I look a lot at the Simplify ETFs, and to kind of answer that question of, well, what about 60/40? To me, it's a lot more about convexity. Not that I am an expert on this at all, but our friends at Simplify Funds, they're big into sort of various convex strategies, and the idea being if you have really good brakes on your car, then you can go really fast because you can stop when you need to. 60/40 is sort of like having a governor on your golf cart, and you're just assuming that the drag on the bonds is always going to help. But when correlations go to one, it doesn't matter how many bonds you have, you're going to suck. And so convexity can really help because that'll just help you take some risk off when it needs to come off. And Simplify tends to do that. So, I mean, if you're looking for some yield enhancers, go take a look at some of their funds. And I own quite a few of those in client income portfolios right now. Is that helpful?
Yeah. No, it's super helpful. Yeah, no, those are interesting. I mean, PFIX, God, I should have longed it. I shorted it recently, but that's my own personal problems. But yeah, yeah, no, I think that's a great point. I think TYA is a really interesting,
Yeah, or
and eventually will
take
be.
a look at AGGH. The thing's paying like 11%. It's taxable, but you got to do your own research and your own due diligence to say, does that seem like an appropriate risk to take? There's also a volatility structure where they're essentially trying to make the difference between the 3 and the 1 month VIX in SVOL. You might take a look at that. They did cut their dividend from 32 cents down to 30 cents. But it's kind of it's Mike Green's answer to XIV that went bankrupt because it was way too aggressive. This thing takes much less of a position betting on vol and a kind of a steep vol curve. I think it's worth exploring and taking a look at it.
Yeah, for sure. And I think that's I do actually really think that Simplify is doing a good job of giving advisors exposures that they wouldn't otherwise have. And I think it's a really cool thing. Cool. What else? Anybody else want to come up? I think, you know what I'll do? I'm going to close this down actually, unless someone else can start a space. I just wanted to talk about some bond stuff. So thanks everybody for coming by. I'll close on a story. Carpathia Portfolio Management is a guy. I don't know him at all. I've never talked to him, but I just see him on these spaces. He told his story in a space I was in earlier, and I thought it was really interesting. Back to like Thomas and the Death Star and just trying to do the right thing for people thing. And I thought it was so interesting. This guy said that he would basically cut his own fee by 80% when he got built conviction that the market was essentially like coming down. And he would take people 80% out and keep 20% in risk and charge the fee, and then 80% would be like something like some sort of CD or fixed account. And I think that's such an interesting that. I've been in the industry for 11 years, and I really sometimes get I think that's a really interesting thing, man. Like I think that there is to Thomas's point kind of a shift going
Yeah.
on. Dude, 10-year is blasting straight up. Somebody's blowing up out there, and yeah, man, I don't know. I just really appreciate. Here's what I'm trying to say. I really appreciate like having a little study group
Yeah.
to learn from, and I really think that like most of I think the guys that tend to hang out on here are naturally selected for people that want to learn and not just put people in the fee paying accounts and just go home.
Yeah, listen, and I'll just leave the last point, right? Like, we all know all sides of this industry, and there's no question it can leave you jaded, completely jaded, completely jaded. Like, there are some bad motherfuckers who don't have anyone's interest at heart except their own. That's not dissimilar from a lot of other industries, right? But the reality is that in trying to appreciate clients' accounts and wanting to present the best outcomes, the guys who are putting in the reps that you hear and see and know are the ones that like I genuinely think the the advisors, the PMs, etc., putting in the reps, with everybody, and everything's so open source now. I can see, like, there's no question. Why would I not take a PM that's not going to defend their shit on Twitter, assuming that it's not like somebody on CNBC or whatever, right? Like that's got to be status quo. Same for advisors, like anyone who's coming up here explaining, understanding. It's a super amazing time to be alive and doing this shit.
Hell yeah, man. Thomas George, ladies and gentlemen. John, I really appreciate you coming up. I learned a ton from you. I want to do this again and throw more tickers at you. I think that I think if anybody wants to learn about closed-end funds, there's nobody that I think John Campreth is a phenomenal resource. He's also a very nice guy, and we'll give you some time. So I really appreciate him. And
Thanks, buddy. Happy to do
yeah,
it.
yeah, for sure. No, and all right. Before this gets any sappier, have a great day. Catch you all tomorrow, some other day. We'll be back in some other space later. Peace.